Modern finance often feels like a digital abstraction, numbers flashing on screens and high-frequency algorithms. But beneath that digital layer sits a physical reality, the raw materials that build, power, and feed the world. If you want to value a publicly traded company, you have a clear set of corporate metrics to work with. You can dig into their balance sheets, analyze quarterly cash flows, and evaluate the specific decisions made by the management team. But you can't read an earnings report for a barrel of crude oil. Gold doesn't have a CEO, and wheat doesn't issue forward guidance. Yet, even without traditional financial statements, the prices of these raw materials fluctuate every single minute the markets are open. To understand what drives a commodity's value, we have to look past the corporate playbook and learn to read the physical and macroeconomic forces of the planet itself. The baseline of commodity pricing comes down to a raw physical balance: how much of a material is being pulled out of the earth versus how much is being consumed by industry. Massive global economies act as the primary engines for that consumption. When nations like China and the United States expand their infrastructure or manufacturing capacity, they create a massive structural demand for industrial materials. On the other side of the equation are the geographic heavyweights controlling the supply taps. Nations like Russia, Saudi Arabia, and Australia dictate exactly how much energy and metal actually flows into the global market. The bridge between those producers and consumers is inventory. Tracking how much of a commodity is sitting in storage provides an essential early warning system for price movements. When storage levels are high, the market is oversupplied, pushing prices down. But when inventories drop, it signals immediate scarcity, often prompting rapid price hikes as buyers scramble to secure the materials they need to operate. Supply and inventory give us a reliable baseline, but these physical goods are constantly at the mercy of external forces that can rewrite the math in an instant. Those forces can suddenly sever global supply chains and wipe out existing stockpiles, bypassing the normal inventory cycle entirely. For agricultural, or soft, commodities, the entire market hinges on precise crop reports and regional climatic shifts. A single weather anomaly, like a severe drought or an unexpected El Niño event, can wipe out an entire season's yield in a matter of weeks, sending grain or coffee prices surging. For hard commodities, like crude oil and industrial metals, the primary disruptor is usually human conflict. Sudden geopolitical tensions, armed conflicts in energy-rich regions, or the abrupt imposition of trade tariffs can instantly throttle the flow of global energy and metal supplies. Even without outright war, coordinated producer alliances can strategically restrict their own production output to manipulate global market prices. Weather and war create sudden, violent price shocks, but there is an even larger invisible economic force that ultimately dictates the baseline value of every physical good. Zooming out from physical goods and national borders, we hit the macroeconomic forces governing all international trade. Because commodities constantly cross global borders, they require a universal benchmark. Almost universally, they are priced in US dollars. This relationship works as an inverse correlation. When the US dollar strengthens, commodities become more expensive for foreign buyers to purchase. That higher cost chokes off global demand, pushing the actual price of the commodity down. But that currency effect is in a constant tug-of-war with global GDP growth and inflation, which trigger massive demand for raw materials to fuel economic expansion. What looks like a single price on a screen is actually a compressed reflection of physical supply, human conflict, and the strength of the US currency. Understanding this price matrix leads directly to the survival mechanisms that global businesses use to navigate extreme volatility. They rely on hedging, a financial strategy where producers and consumers use the futures markets to lock in specific prices against future volatility. To do this, risk managers calculate a hedge ratio. This determines the precise proportion of physical risk that a business chooses to offset using derivative contracts. By running these calculations, vulnerable operations, from single-family farms to global airlines, can keep their doors open. This is where the abstract data of a research analyst meets the practical necessity of a functioning economy. Commodity fundamental analysis provides the data that keeps these global supply chains intact. When an analyst identifies a bottleneck in a copper mine or tracks soil moisture in a grain belt, They are documenting the physical health of the global systems we depend on. Ultimately, the price of a commodity is the final readout of a global balance. It translates our weather, our geography, and our trade policies into a single number: the cost of the raw materials that build our world every day.